take down sales conversation with William Lee. He's chief economist at Milken Institute and so competent on not only international economics in the Pacific Rim, but also a student of our domestic economy. Bill Lee, on the break into this, we were talking about this recession. You say for America, it's different. This is a recession where workers will benefit and the fancy people may not.
Well, Tom, given the shortage that we have in warehouse workers, service workers, waiters, and nurses, it's very clear that the wage increases are telling everyone we need more of them. And even if the economy turns down, I think the Amazons of the world will continue to hire blue collar workers. So this will be the first white collar recession in the longest history of the United States. So I think if we were to have a recession that spreads into the labor market, we're going to find that the regular workers, the Joe Sixpacks out there will be safer than the computer programmers and middle managers.
I don't understand the distinction for so many Americans, Bill Lee, of an outright NBER recession and something that you and I used to call a growth recession. I used to feel pretty bad in a growth recession, right?
When things slow down, income slow down, and spending slows down. The reason why is because you feel crummy. I mean, you don't have enough money to spend, and especially given the high inflation that we have now, stagflation really induces and is a precondition for a growth recession. And you're right, you don't feel good in a stagflationary environment.
Bill, how quickly could we see labor really turn?
You know, that is a great question, because right now Chair Powell's been saying we have a really tight labor market because we have so many vacancies out there. But if you look at the pace of hiring, the firms are not hiring at a faster pace, even though they were raising wages. So what I think is that there's really a microeconomic disequilibrium going on. The dislocation in the labor market is one where firms are looking for better workers, and workers are looking for better jobs because they feel that they have now retrained themselves and qualified for better jobs and higher pay. So the only way to solve this problem is with higher productivity, and the only way to do that is to have the adequate investment. And we're not going to see that with the kind of results that Tom just talked about with the shortfall in earnings that companies are experiencing.
So just to parse that out a little bit more, are you basically saying that this is going to right itself in the near term, and then you'll start to see a creeping up in the unemployment rate? How does this sort of change the trajectory as people talk about a technical recession, but not a real one, because the employment picture hasn't been participating to date?
I think as we see the 2 quarters of negative GDP growth in the bag, we're going to see the weakness spread into the broader economy, and then the firms will react by, as I said, hiring more of the blue-collar workers because they still need them, but they're going to try to employ technology to roll back the advanced workers, and you'll see the unemployment start to affect that segment of the labor market, which is service sector is a very large segment of the labor market.
Bill, Bruce Kasman was on yesterday with J.P. Morgan. It's a small bank. You may be familiar with it. And Dr. Lee, Dr. Kasman made very clear it's exports to the rescue as possibly the Pacific Rim opens up. Are you optimistic that we will get export growth off the Pacific Rim, or is that something that awaits COVID and the reopening of China?
Well, Tom, that's a loaded question because Bruce is a classmate of mine at Columbia, and we go back a long ways. And as much as I admire Bruce's analytic capabilities, I think he's missed it there. The exports to the Pacific Rim are going to be limited because the growth from the Pacific Rim, namely China, is going to be very limited. China is now suffering from enormous amount of domestic dislocation with their COVID policies and their shutdowns, and structural policies with a huge rise in youth unemployment and the depression people are in and affecting consumer spending. So the only source of demand that may come from the Pacific Rim would be the outer rim, the ASEAN countries.
Bill, just because this is so important, can a totalitarian regime, particularly one going into a party fest in November, can they unilaterally affect a slowdown or depression?
Well, they're trying to goose up the economy like crazy. They're issuing a lot of debt. They're trying to do the same old playbook, which is infrastructure spending. Unfortunately, the private sector is what's collapsing, and given that property market is no longer a real store of wealth for people, people are not spending. So as far as I can see, and as far as the eye can see, China is going to take a while to recover back from a 3-handle and 2-handle on its growth rates.
Bill, to tie a bow on all of this, yesterday we had two guests on, Ed Yardeni, followed by Nouriel Roubini. Ed Yardeni said we'd seen the bottom in the stock market. Things were looking up. The U.S. economy was resilient. The world wasn't so bad. And then Nouriel Roubini came on and said it could be worse than the 1970s. We're facing stagflation. We're facing all sorts of terrible things. Where do you stand?
Congratulations on your range of guests. I'm going to have to stick it in the middle. I agree that the markets seem to be sniffing out a bottom because they're seeing the bottom of the recession that's yet to come. They may not estimate its magnitude, but they are seeing the bottom and they're planning for the recovery. As far as the rest of those are concerned, high prices are still killing us. The inflation is likely going to stick longer, and consumer depression is going to likely hang on for quite a while.
Bill Lee, awesome to catch up. As always, buddy, from the Milken Institute, as we look ahead for a Federal Reserve, a two-day meeting begins today. Alan Ruskin of Deutsche Bank asked a really important question, Tom. Not just about where we'll peak, but how long we'll stay at that peak in Fed funds. And I don't